Hello my fellow investors, and welcome back to another episode of this mini series where we are looking at all 11 sectors and figuring out which companies actually are at a pretty good value / 52-week low, seeing that the market, guys, has been falling recently. And so far we have done pretty much the tech, the communications, the consumer cyclicals, and today we're going to look at consumer defensives. Now, I'm not going to take a look at, guys, companies like Walmart, Coca-Cola, companies that I have done on the channel before. I'm actually going to take a look at more obscure ones. And of course, always remember, before we get started, this is not financial advice, guys, and every investment is the present value of all future cash flow. So with that said, guys, let's get started with our first company at 52-week lows, and that is none other than Tyson Foods. Yeah, guys, Tyson Foods is actually a company that's in the 52-week lows. Now, for all those of you who may not know, this company, well, they package a bunch of stuff. They package a lot of foods, right? They make a lot of food as well, especially when it comes to like chicken and that kind of stuff. Pretty sure you have seen their brand on grocery store shelves. And well, if we actually take a look at this company, guys, we can see that on the 1 year they're down 18.8%. On the year to date, they're down 27.23%. So you can see on the 52-week range, $63.44 at the lowest. So the ticker symbol of TSN, market cap of almost $23 billion and a PE of 5.73 and its current share price of $63.89, guys. This is looking like a really interesting buy right now. Now, they do pay out an annual dividend of $1.84, which ends up being a yield of 2.81%, a 15.38 5-year CAGR, and 10 consecutive years of dividend growth. And on top of that, guys, the ex-dividend date is actually coming up on November 11th, and they pay out on the 15th of December. So this might actually be a pretty decent buy right now, mainly because if you buy before this ex-dividend date, you will get that dividend on the 15th of December. But looking further into this dividend, we can actually see that they pay out $662 million in dividends every single year, which in regards to the 5-year average free cash flow, they're still left with $1.31 billion, and as of last year's free cash flow, it is almost $2 billion. These payout ratios come out to be 25.15% for the last year's free cash flow and 35.58% for the 5-year average free cash flow, significantly lower than my cutoff of 60%. Looking at these fundamentals, starting of course with the net income, $1.77 billion to $3 billion, increase of 72%. Really nice increase. We do see an outlier here 4 years ago, but nonetheless, steady increase. Free cash flow, we also get another increase, $1.5 billion to $2.6 billion, increase of 72%, with an average of $1.97 billion. We see an outlier here 3 years ago, but aside from that, guys, really nice consistent increase. When it comes to the revenue, very solid as well. 5 years ago of $38.26 billion to 1 year ago of $47.05 billion, increase of 23%. Assets minus liabilities, this is also looking very consistent as well throughout the past 5 years. Currently, they are at $19.5 billion. Average total assets is $32.85 billion. Average liabilities is $17.8 billion. And doing this difference, we get $15 billion. Cash flow minus the liabilities, this unfortunately isn't looking too good, but that's also not looking too bad as well. Currently, they're at negative $15.8 billion, and we can see that they have been getting this closer to zero ever since 3 years ago. Average cash flow minus the average liabilities, we get negative $16.1 billion. Shares outstanding could be a little bit better when it comes to how aggressive they're buying back, but they are buying back nonetheless. 5 years ago of 368 million shares to today of 359.6 million shares. That is a decrease of 2.28% on the 5 year, and on the previous to the current year, they're at 1.5% on share buyback. And they currently hold $1.1 billion in cash and equivalents with an average of $1 billion. Making some really quick assumptions, guys, in regards to the revenue and projected share buyback, and keeping the required rate of return at 10%. For the target share price, not adjusting for debt, this puts me between the range of $89.55 to $97.81, not adjusting for debt, and $72.38 to $80.29. Even adding a margin of safety of 5 to and 15%. Majority of these is actually above the current share price of $63.89. Only one of them, lowest assumption, 15% margin of safety, is the one that essentially doesn't reach it. But aside from that, guys, all of these values is telling me that, yeah, this might actually be a pretty decent price at this point. And on top of that, with this current annual dividends per share of $1.84, putting in $5,725, this nets you $164 $54.88 in annual dividends. All in all, Tyson Foods, 52-week low company, and this might actually be a pretty decent buy to buy this company at in accordance to discounted free cash flow. Now with that, let's head over to the second company, and that is the company Mondelez, which, guys, is a company that you may not actually know what they do, but they actually have a lot of snacks that a lot of people know. For example, they have things like Halls, Milka, Oreo, and Original Philadelphia, which is like the cream cheese kind of thing. So they do have a lot of good products that people tend to buy, and it's not just Oreos. And looking at the graph, guys, they are at a 52-week low. On the 1 year, they're down 7.73%. On the year to date, they're down 16.23%. Looking at this range, so you can see the lowest was $54.74. So with a ticker of MDLZ, market cap of $75.7 billion and a PE of 20.05, which is right there, almost reaching my 20 PE mark, with a current share price of $55, really close to the 52-week range, this might actually be fairly good. Annual dividends of $1.54, which ends up being, guys, a dividend yield of 2.76%, payout ratio of 47.78%, and a 5-year CAGR of 12.68%. It's absolutely massive, and 8 consecutive years of dividend payment as well. Ex-dividend date passed as of September 29th. Payout date is actually coming up on the 14th of October, and they pay their dividends quarterly. Based on their shares outstanding, this $1.54 in annual dividends becomes $2 billion being paid out in dividends every single year, which unfortunately, in regards to the 5-year average free cash flow, they're only left with $636 million, and as of their last year's free cash flow, they're left with $1 billion. These payout ratios come out to be 66.54% for the last year's free cash flow and 76.85% for the 5-year average, which is telling me that it's getting high up there when it comes to affordability. Coming now into the fundamentals, guys, we got the net income 5 years ago of $2.8 billion to 1 year ago of $4.3 billion. That is an increase of 52%. Really nice, consistent increase in their net income. Small dip 2 years ago, probably because of COVID, but then they recovered fairly nice. Looking now at the free cash flow, we also see a nice steady increase, though we did see a massive jump from 5 years ago to 4 years ago. 5 years ago, $1.579 billion to 1 year ago of $3.2 billion, increase of 101%, with an average of $2.75 billion. As you guys can see by the graph, really nice steady increase in the free cash flow. Only issue that I see is this massive jump from 5 years ago to 4 years ago. Looking now at the revenue, also a pretty good increase, though we do see a little bit of stagnation here from 4 years ago to 2 years ago. 5 years ago, it was $26 billion. To 1 year ago of $28.7 billion, increase of almost 11%. Assets minus liabilities, if we subtract these two, guys, we essentially see if the company is able to survive an economic downturn. Currently, they're at $27.6 billion, and within the past 5 years, they have increased this, though not consistently. It's kind of remains kind of stagnant, but with small increases overall, which is not too bad. Average assets is $65.2 billion. Average liabilities is $38.1 billion. And doing this difference, we get $27.1 billion. Looking now at the cash flow minus liabilities, seeing if maybe the cash flow is able to subsidize their liabilities, which is essentially what cash flow does. It helps pay down debt. Unfortunately, well, this is kind of leaning down towards the overall more and more negative. However, it's been pretty stagnant within the past 5 years, currently at almost $35.6 billion in the negatives, and 5 years ago it was at $35.3 billion in the negative. Average cash flow minus the average liabilities is $35.3 billion. Coming now to the shares outstanding, the most underrated of all the metrics, guys, we got a massive decrease over here. We got 5 years ago of 1.5 billion shares to today of 1.37 billion shares. That is a decrease on the 5 year of 7.78%, and from the previous to the current year, that is another decrease of 1.39%. Every single year, guys, they have been decreasing this, not a single time that they have increased it, which is really good. They are buying back shares, decreasing that payout ratio in regards to that dividend. So all in all, it's actually a really good thing for them to do, giving you guys a bigger piece of the pie, and on top of that, lowering their payout ratio. And lastly, when it comes to the cash and equivalents, they currently hold almost $2 billion with an average of $2 billion. Now making some assumptions, guys, using of course low, median, and high assumptions, using 3 different factors of revenue growth, where I'm going to put 7, 8, and 9% for each assumption. For the projected share buyback, let us go with 5, 8, and 9%, and keeping the required rate of return flat at 10%. Guys, this puts me between the ranges of $41.89 to $46.69, not adjusting for debt. Adjusting for debt, this does come down to $29.83 to $34.13. And adding a margin of safety, this puts me between the ranges of around $25.36 all the way up to $32.42 for the low and high assumption. So as you guys can see, we are still under the current share price. However, guys, the fact that at the highest point it is $46 and the current share price is $55, this might be a scenario where you actually might consider paying that premium of $9 just to buy into this company, seeing that it is at a 52-week low and has a pretty good PE for that matter as well. Nonetheless, guys, Mondelez is a company that honestly never thought about buying, didn't even know that they owned Oreo either, but by the looks of it, their fundamentals are really solid and they might continue that into the future. Now with that, let's head over to the last company, and that would be the company Monster Energy Drinks. Now this one, guys, actually came in as a pretty weird one because I wasn't expecting this one's fundamentals to be this good. But looking in further into this company, guys, we can see that unfortunately they are not in the 52-week range. On the 1 year, they are up 0.24%, and on the year to date, they are actually down 6.5%. The 52-week ranges is between $71.78 to $99.81. Coming into the calculator, we got the ticker symbol for MNST, market cap of $47.57 billion with a PE of 39. So it's kind of telling me that with a current share price of $90.29, it is a little bit expensive. Now, they do not pay out the dividend, which means that all of their free cash flows is going straight into themselves, which may actually be a pretty good thing, assuming that they may be buying back shares. Looking into these fundamentals, guys, starting of course with the net income, we got 5 years ago of $821 million to 1 year ago of $1.4 billion, increase of 68%. Free cash flow, kind of stagnant, but an increase nonetheless. 5 years ago of $904.3 million to 1 year ago of $1.11 billion, increase of 23% with an average of $1.1 billion. The revenue looks absolutely amazing, going from $3.4 billion to 1 year ago of $5.5 billion, increase of 64.5%, and it's also really steadily increasing as well. In regards to their assets minus their liabilities, we can see that they're currently at $6.8 billion, and it has been somewhat consistently increasing within the past 5 years. Average total assets, it's around $6.12 billion. Average liabilities is $1.1 billion, and doing this difference, we get around $5 billion. Looking at the cash flow minus the liabilities, this is actually fairly interesting because we do have a lot of years here, guys, that they're actually in the positive, meaning that their cash flow was able to take care of their liabilities, which is actually fairly surprising. This is really rare. Only as of 1 year ago is when they actually went into the negatives to negative $126 million. But overall, guys, it's actually been in the positive a significant amount of times. Average cash flow minus the average total liabilities, we get a positive $74.62 million. Looking at the shares outstanding, this is also looking amazing. Not one single year have they issued shares, and they've been buying back very aggressively as well. 5 years ago of 566.3 million shares to today of 527 million shares. That is a decrease of almost 7% on the 5 year, and from the previous year to the current year of almost 0.5%. And now when it comes to the cash and equivalents, they currently hold $1.1 billion with an average of $934 million. Making some assumptions of low, median, high, using revenue growths of 15, 16, and 17% for each assumption, and a projected share buyback of 5, 6, and 7%, we get the target share prices, not adjusting for debt, of $36.61 all the way up to $39.82. However, adjusting for debt, guys, this now goes all the way up to $75.48 to $81.95. So I understand that currently the current share price is slightly higher than even at the highest share price, guys, but it's only around $8 away from this current share price, so it may actually be a fairly good price to buy at, assuming that you're willing to pay this premium of around $8 or so with the current share price. All in all, Monster Beverage, really surprising. I was not expecting it to be this good of a company when it comes to their fundamentals. Maybe a little bit high, but it might still fall within your margins of safety to actually buy this company today. And that pretty much does it, guys, for the consumer defensives. I gotta be honest with all of you guys, this was a really difficult sector. None of these companies here either have amazing fundamentals, or if they do have amazing fundamentals, they're just really expensive at the current moment. So this actually took a really long time, guys. This actually took 2 days to do this video. So yeah, that's unfortunate, but not a lot of good solid companies that are a fair value at this current sector. But we're done with this one, guys. But next time, guys, come back for when we're going to do the financial sector. Hopefully I have a better time in this sector. There are a lot of good solid companies here, so hopefully this one's a little bit better. So with that said, peace out, and I'll see you all in the next video.